Today, we'll be talking about forest land incentives in the Internal Revenue Code. I'm Dr. Tamara Cushing from Clemson University. This timber tax educational opportunity is provided to you by the Forest Landowners Tax Council through a grant from the Forest Landowners Foundation. The Forest Landowners Tax Council is a national nonprofit organization dedicated to education of and providing a voice for family forest owners on issues of federal taxation. Today we'll be talking about the reforestation tax incentive, taxation of cost share income, and explaining what income averaging is and how it applies to forestry. Let's start by talking about reforestation. So reforestation occurs when you take a plot of land that previously had trees on it and put trees back on it, whether it's done through artificial or natural methods. Another term we use is called afforestation. Afforestation refers to taking a plot of land that was not previously forested and making it into forested acres. These are typically agricultural lands that have been converted over. So the Internal Revenue Code, when we talk about the reforestation tax incentive, we're talking about expenses related to site preparation, seed or seedling purchase, and brush or weed control. Basically, those expenditures that it takes to get the stand established. Now, stand establishment or reforestation may be done through natural or artificial methods. Artificial methods typically include hand or machine planting. Natural regeneration often includes making the ground conducive to tree growth that occurs naturally through seeding in from nearby trees. Either one of these methods is going to qualify for the reforestation tax incentive. This reforestation tax incentive is the outright deduction of expenses up to $10,000 per tax year per qualified timber property. Now, if you go over the $10,000, all is not lost. The remainder of the expenses that go over $10,000 may be amortized or written off in a straight line method a little bit each year over the next 8 tax years. The result of this process is the complete recovery of reforestation expenses within 8 tax years. For those of you that are wondering how this interplays with the basis that we talked about in a previous video, if you have taken the reforestation tax incentive and amortized the rest of the expenses related to reforestation, unless there's any additional treatments done that would need to be capitalized, there'd be nothing left in the basis account at the time of a sale. So who's eligible for the reforestation tax incentive? Whether you're in an estate or a sole proprietorship or married filing joint, it doesn't really matter. You're still eligible for the reforestation tax incentive. That includes the deduction and the amortization of the remaining expenses. Now, for those properties that are held in trust, trusts are not eligible for the $10,000 deduction, but they are eligible to amortize the entire amount over the 8 tax years. So let's look at an example reforestation property. So the landowner spends $25,000 on reforestation related activities in 2012. On the 2012 tax return, they can take an outright deduction of $10,000 in expenses. The remaining $15,000 will be amortized over the next 8 tax years. In 2013, the landowner can take another $10,000 deduction and a subsequent amortization on any new reforestation activities that are undertaken on that property or other parts of the property. There is some tax strategy to be employed to using the reforestation tax incentive. The reforestation incentive is currently available each tax year. Often in forestry, we stagger our operations due to operation limitations and due to the climate that we live in. So we might see that a landowner does site preparation type of work in the fall and early winter to try to get the ground ready for the subsequent tree planting that will happen in the early spring, late winter, depending on where you live. Well, knowing that we're naturally staggering these operations anyway, and the tax law allows us to have a $10,000 per tax year, you can see that staggering our forestry operations has crossed into 2 tax years. So we can take advantage of these staggering operations, do the site preparation in 1 year, take our $10,000 and amortize the rest, and then when we go into the next year to do the planting, we have another $10,000 available. So we've basically gotten $20,000 to get that reforestation accomplished on that land. So let's look at an example using that strategy. The landowner spends $15,000 on reforestation related activities such as site preparation in 2012. They then go and plant the trees in 2013. So in 2012, on their return, they're going to deduct $10,000 for those reforestation related expenses that were tied to site preparation that occurred in 2012. The remaining $5,000 will be amortized over the next 8 tax years. The landowner can then take another $10,000 deduction on the tree planting that occurred in 2013 on the 2013 tax return. A couple of quick notes on the reforestation incentive. The reforestation incentive has to be taken on a timely filed return. If you receive cost share income to pay for reforestation expenses, those cost share dollars must be included in your income in order to take those dollars off from the reforestation incentive. There is no carryover of unused deductions, so if you don't make the $10,000 maximum that you're allowed to take off in the deduction, you can't carry that over into the next tax year. And we have recapture provisions on this incentive. These recapture provisions basically say that if you sell the timber within the first 10 years of taking the reforestation incentive, so when you first take that deduction, you've got 10 years. If you sell the timber in that time frame, there's going to be some penalties on the tax benefit you received from taking the reforestation tax incentive. So let's move on to cost share. What is cost share? These are programs that provide matching funds for landowners for operations done on their property. We see cost share dollars that range anywhere from 60 to 90% of the expenditures that the landowner incurred. Some programs that you may have heard of in the past include WIP, the Wildlife Habitat Improvement Program, EQIP, the Environmental Quality Incentives Program, and CRP, the Conservation Reserve Program. These are just some examples. It's not important to know the particular names. The names change. They're tied to Farm Bill programs, so programs come and programs go. There is a list that you can find that describes the programs that are available from the federal government and state governments. So how is that cost share income treated? Well, income that's received from any source is considered taxable unless the Internal Revenue Code tells us differently. In the case of cost share income, the Internal Revenue Code allows part or all the payment to be excluded as long as it qualifies. The payment has to have been declared by the Secretary of Agriculture to be for conservation-related purposes. So how much of those payments can be excluded? Well, there's 2 formulas here on your screen in front of you. And we're going to take the greater of the 2 numbers. We're going to take 10% of the prior 3-year average annual income and divide that by the Farm Credit System Bank interest rate that prevails in your region. Or take $2.50 and multiply it by the number of acres, and then divide that by the Farm Credit System Bank interest rate in that region. Whichever number is larger is the amount that you're going to be able to exclude. Now let's talk for a minute about CRP, the Conservation Reserve Program that I mentioned before. There's actually 2 pieces to that program. Part of it is a cost share program, much like I described to you, where a landowner does a treatment on their property or an operation, and they're given money back in the form of a reimbursement to share the cost. The other part of the payment is more of a rent or a royalty paid to the landowner on that property. Now the first part, the part that's cost share, will qualify for exclusion based on these formulas. The other part, the rent or the royalty part, actually is considered ordinary income. If you elect to exclude based on those formulas, you have to include a statement that shows the total cost of the operations done on the property, the amount of the cost share that was received, the date the payment was received, the purpose of the payment, the amount that's going to be excluded, and how the exclusion was calculated. I'd like to take a quick minute to talk about income averaging. Income averaging is a provision in the Internal Revenue Code that's available to certain taxpayers that allows income to be assigned to a prior year. The intent behind this is to take taxpayers who, due to the natural cycle of the product that they're producing, have years where there's no income being produced, and then all of a sudden they have a larger amount of income. This income averaging allows them to take that and spread it out a little bit for a better distribution of the tax bill to them, recognizing that the income really was earned all the way along the way. This provision is available for farmers, but it's not available for forestry. I'd like to extend a special thank you to the Forest Landowners Tax Council for funding this project. And I'd like to encourage you to visit www.fltc.org and join the Forest Landowners Tax Council. If you're on Facebook, I'd like to encourage you to like FLTC. And if you're on Twitter, make sure to visit FLTC at FLTC96. Once again, thank you to the Forest Landowners Tax Council, and have a good day.